So before we get completely lost in the absolute chaos of corporate bankruptcy today, just a really quick shout out. This deep dive is brought to you by CertFuel,
Oh, yeah, they're great.
right? Like if you're studying for the Securities Industry Essentials exam, they have this full course. It's got adaptive study quizzes, smart flashcards, and this is the best part, unlimited practice exams that are weighted exactly like the real thing.
Which is huge, honestly.
It's an incredible tool to get you across the finish line. So just check them out at certfuel.com.
Highly recommend.
Yeah. All right, let's actually get into it. Welcome to the deep dive. If you are listening to this right now, I mean, you are staring down the barrel of the SIE exam.
And it is a big barrel.
It really is.
Right.
And let's be honest, studying for the products and risks chapter, it can feel like you're trying to memorize a financial dictionary that's like printed in a foreign language.
It's incredibly dense.
It's so dry, and there are just a million little rules. But today, we are conquering equity securities. This topic alone makes up, 44% of the products and risks section?
Yeah, 44%. It is massive.
It's the absolute bedrock of the test. Like, if you don't nail this, the rest of the exam is just going to be a total nightmare. But listen, we aren't just going to sit here and read flashcards at you.
No, please no.
Right, that's the worst. We are going to build a universe today. We are going to learn the why and the how behind all these rules using some deeply ridiculous scenarios.
Oh, I love the ridiculous scenarios.
Because honestly, that's how it sticks, right? You won't be able to forget this material, even if you tried.
That's exactly the right approach to take. Because, when you strip away the flashing numbers on the CNBC ticker,
The algorithms, the high-frequency trading.
exactly, all the derivatives and the noise, equity is really just the concept of ownership. That is the foundational building block of global capitalism.
Just who owns what.
Right. Everything else we look at in finance, like the corporate bonds, the exotic options contracts, the swaps, it is all just dancing around this central core concept of who actually owns the company.
Yeah, who holds the keys.
And if you don't deeply understand what an owner is entitled to, and just as importantly, what they are explicitly not entitled to, none of the advanced market mechanics will make any logical sense to you.
They just won't click.
Right, they won't. So we have to start at the absolute baseline.
I love that, the baseline. So before we get into like the crazy hybrid securities or international depository receipts, we are starting with the purest form of ownership in existence.
Common stock.
Common stock. And to really anchor this abstract concept, we're going to use a recurring character today. So I want you to imagine a guy named Buffett Bob.
Buffett Bob.
Yeah, picture Bob. He's in his stretchy pants. He is standing at this massive all-you-can-eat corporate buffet. And this sprawling table of food, it represents the total profits and the tangible assets of a corporation.
Nice visual.
Right. Now, the textbook definition says that as a common stockholder, Buffett Bob is a, quote, residual owner.
Yeah.
But let's translate that into the real world. What does being a residual owner actually mean for Bob at this buffet?
Well, it essentially means Bob is legally required to eat last.
Oh, man.
Yeah, that is the core mechanism of a residual claim. Just think about the word residue, right? It's what is left over at the bottom of the barrel after literally everything else has been extracted.
Like scraping the pan.
Exactly. When a company generates revenue, Bob is basically forced to stand at the very back of the room. Every single creditor, every bank that loaned the company money, the bondholders.
The employees, the IRS.
Yep, the IRS always gets theirs. And even the preferred stockholders. They all get to take their plates up to the buffet and serve themselves first.
And Bob is just watching.
Just watching. Bob just has to stand there. His stomach is growling, and he's watching them carve up the prime rib.
Yeah.
He only gets the residuals. I mean, he gets whatever food is left on the table after absolutely everyone else in the corporate ecosystem has been completely satisfied.
Okay, so I have to play devil's advocate here. Because if I'm Bob, this sounds like an unbelievably terrible deal.
It does sound bad on paper.
Right. If I'm the literal owner of the restaurant, why am I standing at the back of the line watching the bankers eat my prime rib? Why on earth would anyone voluntarily buy common stock if it puts them in the absolute worst position to get paid?
Because of the upside. It's the ultimate trade-off in all of finance.
Okay, walk me through that.
So, yes, Bob eats last. But here is the structural magic of common stock. There is absolutely no mathematical cap on how much food could potentially be placed on that table.
Oh, I see.
Think about the bondholders and the preferred stockholders who get to eat first. They are only legally allowed to take a very specific, strictly capped amount of food.
Like their fixed interest rate.
Exactly. A bondholder gets their 5% interest rate, which is their standard plate of food, and then they are legally required to leave the room. They don't get a second helping, ever.
They get their slice and they're out.
Right. But Bob, if this company suddenly invents, like, a revolutionary artificial intelligence chip or strikes a massive oil reserve, the buffet table is suddenly going to be miles long.
Just mountains of food.
Mountains of it. And because Bob is the residual owner, once those fixed capped obligations to the bankers are paid off, every single scrap of that infinite mountain of food belongs entirely to him.
Wow.
Yeah, there is literally no ceiling on his potential wealth. People buy common stock because they are completely willing to trade priority in line for the chance at unlimited, infinite growth.
Okay, that makes total sense. He is taking the very real risk of getting nothing but breadcrumbs for the chance to eventually inherit the entire bakery.
Exactly.
But this brings us to the first major hurdle of the exam. The test writers, they are going to try and trick you into thinking that Bob's risk is as infinite as his reward.
Yes, they absolutely will.
They're going to heavily test your understanding of limited liability.
And to understand limited liability, you really have to realize that it is arguably the single greatest invention in the history of modern economics.
That's a bold claim, but it's true.
It is, because before the concept of the modern corporation existed, if you owned a share of a shipping business and that ship sank, the creditors could literally come to your house.
Oh my God.
Yeah, they could take your personal savings and legally sell your family farm to cover the debts of the business.
So nobody wanted to invest.
Right. Nobody wanted to invest because the personal risk was just catastrophic.
Which brings us back to Buffett Bob. Let's say Bob pays $50 to get into this buffet. That's his initial investment, right? He bought a share of stock.
Right.
But suddenly, the buffet goes completely bankrupt. They owe millions of dollars to the commercial meat supplier and the landlord who owns the building.
Mm-hmm.
The exam is going to ask you, can those angry creditors march right past the empty buffet, drive to Bob's personal house, and legally repossess his personal refrigerator to pay off the restaurant's debt?
And the answer is absolutely not.
Thank goodness.
The corporate structure creates this legally impenetrable firewall between the business and the individual owner. Bob has limited liability.
So what's the worst case scenario for him?
The absolute maximum amount of money Buffett Bob can lose is his entrance fee. The $50 he initially invested to buy the stock.
That's it.
That's it. Yes, he can lose 100% of his initial investment, which is painful. But his personal assets, his house, his car, his children's college fund, those are completely and permanently walled off.
So on the exam, if you ever see an answer choice suggesting that a common shareholder owes corporate debts personally or can be forced to inject more capital to save a dying company, just cross it out immediately.
Instantly, it is a fundamental trap. Shareholders lose their investment, but nothing more.
Okay, so Bob has unlimited upside and strictly limited downside. That perfectly explains the financial mechanics. But ownership isn't just about collecting profits.
No, it comes with power.
Exactly. Bob isn't just eating at this buffet. Because he is a common stockholder, he actually gets to vote on the menu. He votes to elect the board of directors, he votes on stock splits, he votes on whether the company should merge with a competitor.
He has a voice.
But how that voting math actually works is heavily, heavily tested. The exam fully expects you to know the difference between statutory voting and cumulative voting.
Two very important terms.
And honestly, these just sound like boring legal jargon. So break down the actual mechanics for us. How does it work when Bob steps into the voting booth?
Okay, let's strip away the legal jargon and just look at the raw math. Statutory voting is the standard default method for most corporations.
Okay.
It is strictly one vote per share per open position on the board. So imagine there are 3 open seats for the board of directors. We'll call them seat A, seat B, and seat C.
Simple enough.
And let's say you own 100 shares of the company. Under statutory voting, you are giving 100 votes specifically for seat A, 100 separate votes for seat B, and 100 separate votes for seat C.
Okay, I have my 3 stacks of 100 votes.
Exactly. And the key here is you cannot mix them. You cannot combine them. You must vote for each seat in an isolated silo.
Okay, let me stop you right there, because I see exactly how the test writers are going to frame this.
Yeah.
They are going to ask who this method actually benefits.
Yeah, they will.
And if I just do the math in my head, it heavily benefits the massive majority shareholder.
Oh, absolutely.
Because think about it. If I own 100 shares and some massive institutional hedge fund owns 1,000 shares and we go to vote on seat A, I cast my 100 votes from my rogue candidate The hedge fund casts their 1,000 votes for their corporate insider. I lose.
You lose big time.
Right. And then we move to seat B. I cast my 100 votes. They cast their 1,000 votes. I lose again. Seat C, same exact thing. Under statutory voting, if you own 51% of the shares, you control 100% of the board seats. The minority shareholder is basically just throwing pennies into the ocean.
That is precisely the systemic flaw that the exam wants you to recognize. Statutory voting allows the majority to maintain absolute dictatorial control over the entire board.
It's ruthless.
It really is. But this is exactly why the alternative, cumulative voting, was created. Cumulative voting completely rewrites the mathematical rules of engagement to protect the little guy.
How so?
Well, under cumulative voting, the walls between those silos are knocked down. All of your votes are pooled together into one giant bucket.
Okay, let's run the exact same numbers under the cumulative system just to see the difference.
Okay, so again, you have 100 shares and there are 3 open seats. Instead of voting in silos, you take your shares and you multiply them by the total number of open seats.
So 100 shares times 3 seats.
Exactly, which equals 300 total votes. Now here is the magic part. You can spend those 300 votes however you want.
Oh, I see.
You don't have to spread them out. You can take all 300 of your votes and aggressively dump them entirely onto one single candidate for one single seat.
Okay, I want to pause right here. I'm going to ask you, the listener, a direct question. I want you to put yourself in Buffett Bob's shoes for a second.
Good exercise.
You own a tiny fraction of a massive company. You are a minority shareholder, and you are terrified that the current board is just running the company into the ground. You want to get just one rogue activist director onto the board to shake things up, ask the hard questions, audit the books. To achieve that exact goal, which voting method are you praying the corporate charter uses? Think about the math we just did.
Pick a second.
Got it. You want cumulative voting. You absolutely need cumulative voting.
Without a doubt.
It is literally the only way you can pool all of your limited minority power into a single concentrated strike to force your one candidate through the door, bypassing the majority shareholders' wall.
And that is exactly how the SIE exam will frame it. You must instinctively associate statutory voting with protecting the majority shareholder and cumulative voting with protecting the minority shareholder.
Statutory equals majority. Cumulative equals minority.
Exactly. The exam loves testing the intention behind these structures just as much as the math itself.
Brilliant. Okay, so we've got Bob eating at the buffet. We've got Bob pooling his votes to fight the hedge funds. Let's talk about the other way Bob makes money, besides the underlying stock price just going up on the chart. Let's talk about cash dividends.
Dividends.
And I want to clear something up right away, because a lot of novice investors, they just assume that if you own stock in a profitable company, that company is somehow legally obligated to cut you a dividend check every single quarter.
Yeah, that is a wildly common misconception, and it's a fantastic point to clarify. Dividends are never, ever guaranteed for common stockholders.
Not a legal right.
Not at all. Bob does not have a legal right to demand a dividend. He only has a right to receive one if, and only if, the board of directors voluntarily decides to declare one.
Well, they could just say no.
They absolutely could. The board could look at $1 billion in quarterly profits and say, you know what? We aren't paying out a single dime to the shareholders today. We are going to retain all of these after-tax earnings and use the cash to build a massive new manufacturing plant in Texas.
And Bob just has to deal with it.
Bob just has to accept that. That is entirely the board's prerogative. However, if the board does decide to be generous and pay a cash dividend, it triggers a very strict, highly regulated chronological chain of events.
The timeline.
Yes. And you need to know the exact order of these dates completely cold for the test.
Yes, the timeline of dates. This is a classic, heavily tested sequence, and it's often remembered by the acronym DERP. DERP. Let's walk through it.
Let's do it.
So it starts with the deed, that declaration date. This is the exact moment the board of directors steps up to the microphone and publicly announces, good news, we are paying a cash dividend of 50 cents a share.
They are declaring their intention.
Exactly. Then they have to pick a day to officially check the guest list. That is the R, the record date. The board says, whoever is officially recorded on our books as an owner on this specific Friday will receive the check.
Makes sense.
And finally, you have the payable date, which is simply the day the actual checks or wire transfers go out. But wait, I skipped a letter. I skipped the E.
The E. The most confusing one of all.
The ex-dividend date. Break this one down for us.
The ex-dividend date is arguably the most important concept in this entire sequence for the exam. The prefix X simply means without.
Without. Okay.
So the ex-dividend date is the very first day that the stock trades on the open market without the right to receive that upcoming dividend.
So if I buy it then?
If you log into your brokerage account and buy the stock on the ex-dividend date, you are legally too late. The seller you bought it from is going to get that 50-cent dividend check, not you.
Wow.
In fact, if you watch the stock market open on the morning of the ex-dividend date, the stock price will automatically drop by the exact mathematical amount of the dividend.
Really?
Yes. If the dividend is 50 cents, the stock literally opens 50 cents lower because that cash value is actively leaving the company's balance sheet on that day.
Okay, here is where I guarantee the exam is going to try to trick you. Like, it's a classic trap.
Yeah.
They're going to ask you who sets that ex-dividend date.
Oh, they love this question.
Because human intuition says, well, the board of directors set the declaration date, they set the record date, they set the payable date. Obviously, the board of directors sets the ex-dividend date too.
And if you choose that answer, you will get it wrong.
It's a trap.
It's a massive trap. The company's board of directors does not set the ex-dividend date. FINRA sets it. Or the exchange where the stock trades sets it. But the issuer absolutely does not.
Wait, why? Like, why does an outside regulatory body step in and take control of just this one specific date in the middle of the company's process? Explain the mechanics of why FINRA has to get involved here.
It all comes down to the mechanics of trade settlement.
Okay, the plumbing of the market.
Exactly. When you click buy on your brokerage app, you don't instantly own the stock in the eyes of the law. It takes time for the money to move and the ownership titles to officially clear through the global financial plumbing.
Right, the T+1 settlement.
Yes. So FINRA looks at the record date that the company chose the day they are checking the guest list. FINRA then acts like a referee and says, okay, if the company is finalizing the books on Friday and it takes time for trades to settle, we have to draw a hard cutoff line in the sand before Friday.
To give the paperwork time to catch up.
Exactly. So FINRA takes the company's record date and backs it up by one business day to create the ex-dividend date. They dictate the X date to ensure that anyone who buys the stock before the cutoff has enough time for their paperwork to settle and actually show up on the company's record book by that Friday.
Okay, you must remember that distinction for the exam. The board sets the declaration, record, and payable dates. But FINRA sets the X date.
FINRA sets the X date. Write it on a sticky note.
Seriously. That structural reasoning makes it so much easier to remember. FINRA is just accounting for the paperwork delay. All right, let's completely shift this scenario.
Let's do it.
We just established that Buffett Bob eats last. He is the residual owner at the back of the line when times are good. But what happens if the situation turns incredibly dark?
Dark how?
What if the business entirely fails, the doors are padlocked, and the corporation is forced into complete liquidation? How does the law organize the mob of angry people standing outside demanding their money back?
This introduces us to the darkest but most heavily tested area of corporate finance, the absolute priority rule in corporate bankruptcy.
The absolute priority rule.
Yeah. When a company implodes, it doesn't just hand out whatever cash is left in a chaotic free-for-all. The federal bankruptcy courts step in, and the liquidation process is brutally regimented.
To visualize this brutal regimentation, let's introduce our second character today, Bankrupt Brenda.
Oh, boy. Bankrupt Brenda.
Yeah. Brenda is the CEO of a manufacturing company that just completely went under. It is a total disaster. Brenda now has to sell off every single remaining asset the company owns. The massive factory, the delivery trucks, the patent rights, even the office chairs and the half-empty boxes of pens.
Liquidating everything.
Everything. She is going to pile up all that cash in the middle of the room. How does the absolute priority rule dictate who gets handed that cash first?
The absolute priority rule is a strict legal waterfall. It mandates that you cannot pay a single penny to the next level down the hierarchy until the current level is paid in full.
In full.
100 cents on the dollar. If the level above you is only paid 99 cents on the dollar because the cash ran out, the money stops exactly there.
So levels below get nothing.
Absolutely nothing. And the golden overriding rule that governs this entire waterfall is this. Debt always comes before equity.
Always.
Always. A person who lent the company money is a creditor. They have a binding legal contract requiring repayment. A person who bought stock is an owner. They took a speculative business risk.
Contracts beat risk takers.
Exactly. The law protects contracts before it protects risk takers. Creditors get paid before owners.
Right. We need to walk through this strict hierarchy step by step. The exam will absolutely force you to put these in exact order, so we are going to translate the dry financial jargon into the real-world priority line standing outside Brenda's ruined factory.
Okay.
Who is standing at the absolute front of the line, priority number 1.
Priority number 1 goes to the secured creditors.
Secured creditors.
Yes. These are the secured bondholders or the massive commercial banks. And why are they first? Because they have actual physical collateral attached to their loans.
Like a mortgage.
Exactly like a mortgage. When they lent Brenda's company money, the contract explicitly said, if you go bankrupt, we have a legal lien on the specific factory building, or we get to repossess these specific delivery trucks. They have a claim on a hard asset.
Right.
So in bankruptcy, if the company owes them $10 million, the first $10 million raised from selling those specific hard assets goes straight into their pockets.
Okay, let me push back on this with a hypothetical, because this is where the mechanics get really interesting. What if the secured creditor lent Brenda $50,000 to buy a fleet of delivery trucks? But by the time Brenda goes bankrupt, those trucks are rusted out, and the court can only sell them for $10,000.
It happens all the time.
Right. So the secured creditor takes the $10,000. But what happens to the remaining $40,000 they're owed? Do they just lose it entirely?
Brilliant question. And it illustrates the depth of the rule perfectly. No, they don't just lose it. That remaining $40,000 deficit doesn't disappear. It simply loses its secured status because the collateral is gone.
Oh, I see.
That remaining claim drops down a level and becomes an unsecured claim, which brings us perfectly to priority number 2, the unsecured creditors.
Priority number 2. So these are the folks who lent the company money but didn't get a lien on the factory or the trucks.
Exactly. On the exam, you will often see these referred to as general creditors or debenture holders.
Debenture. That's a great vocabulary word.
Yeah, a debenture is just a fancy formal word for an unsecured corporate bond. These investors lent Brenda millions of dollars based entirely on the company's good faith and credit.
They just trusted her.
Right. They looked at the balance sheet and said, you guys are profitable, we trust you. There is no collateral. So they are standing in line right behind the secured creditors. And it's important to note, this tier also includes regular people,
Like who?
unpaid employees who are owed back wages, and the government demanding unpaid taxes. They generally sit in this unsecured tier alongside the debenture holders.
Makes sense. Debt backed by hard collateral is first. Debt backed by nothing but a promise is second. What about priority number 3?
Number 3 is a very specific, riskier type of debt, subordinated debenture holders.
Subordinated.
Right. The word subordinated literally means lower in rank or position. These are investors who bought a very specific type of bond where they explicitly agreed, in writing, to be placed behind the regular unsecured creditors in the event of a bankruptcy.
Wait, if you were lending a company money, why would you ever sign a contract volunteering to be pushed further back in the bankruptcy line? That sounds financially suicidal.
You would only sign that contract if the company bribed you to do it.
A bribe.
And they bribe you with yield. They offer a risk premium. When Brenda was running the company and wanted to raise cash, she might have offered regular unsecured bonds paying, say, 5% interest. But she also offered subordinated bonds paying 8% interest.
Okay, that extra 3% is the bribe.
Exactly. Investors who bought the subordinated bonds took on more structural risk in exchange for a higher reward while the company was healthy. But now that the company is bankrupt, that risk has actually materialized. They only get paid if the secured and unsecured creditors are made completely 100% whole.
Let me stop right there for a direct question to the listener. Let's really test your understanding of the absolute priority rule we just established.
Listen up.
I want you to imagine you are holding one of these subordinated debentures. You are standing in line at priority level 3. The court starts selling the assets. The secured creditors at level 1 get paid in full. Great. The court moves to the unsecured creditors at level 2. But there isn't enough cash left in the pile. The unsecured creditors are only paid 90 cents on the dollar. Based on the absolute priority rule, how much money do you, the subordinated debt holder at level 3, receive?
Think about the waterfall mechanics.
Got it. You get 0, nada, zilch. Because the absolute priority rule strictly dictates that the level above you must be paid in full before you see a single dime. Since level 2 only got 90%, the waterfall completely stops, the well is dry, you get nothing.
That perfectly illustrates the ruthlessness of corporate liquidation. Now, assuming by some absolute miracle there is still money left after all 3 tiers of debt are paid off, we finally cross the massive legal threshold separating debt from equity.
Finally into the owners.
Right. Priority number 4 is the preferred stockholders. These are equity owners, but they are VIP equity. They negotiate at a slightly safer spot in line ahead of the regular owners.
VIPs. And finally, dead last, priority number 5. Standing in the literal ashes of the ruined factory, holding his empty plate. It's our old friend, Buffett Bob, the common stockholders.
The residual claimants.
Bob gets whatever is left. And let's be honest about the real world. In almost every major corporate bankruptcy, the cash runs out somewhere around Tier 2 or Tier 3.
Oh, easily.
By the time the bankruptcy courts even glance at Tier 5, there is nothing left but dust. Bob gets completely mathematically wiped out.
Exactly. And because this hierarchy is so rigid, the exam loves to test your understanding of it by trying to scramble the order.
How do they do that?
Let me tell you exactly how they will try to trick you. They will give you a multiple choice question asking if preferred stock comes before unsecured debt in a liquidation scenario.
Because preferred sounds so fancy.
Right. They do this because the word preferred sounds so safe, so prestigious. It sounds like it should be at the front of the line. Do not fall for it. Preferred stock is equity. Unsecured debt is debt. All debt beats all equity.
Got it.
Even the lowest, riskiest subordinated debenture holder at Tier 3 is going to get paid before the fanciest, most prestigious preferred stockholder at Tier 4. You must memorize the exact sequence.
Let's hear it one more time.
Secured, unsecured, subordinated, preferred, common.
Secured, unsecured, subdebt, preferred, common.
Yeah.
Lock that sequence in your mind.
Okay, let's evolve our narrative a bit.
Sure.
Seeing Buffett Bob get absolutely decimated in Brenda's bankruptcy makes some investors incredibly nervous.
Oh.
Not everyone has the iron stomach required to be at the absolute back of the line.
I certainly don't.
Right. A lot of people want predictability. They want a safer spot in the liquidation line, but they still want to actually own a piece of the company rather than just lending it money. How does the financial system solve for that exact psychological profile? It solves it by engineering a hybrid security. It introduces preferred stock.
Yes. Here's where the structure gets really interesting. Let me introduce you to our third character today, Cautious Carl.
Cautious Carl. I like it.
Carl is a guy who absolutely despises volatility. He hates surprises. He does not want to ride the terrifying roller coaster of common stock prices. Carl wants a fixed, predictable dividend check arriving in his brokerage account, like clockwork.
Very cautious.
Exactly. He wants to know that if the company goes bankrupt, he is standing safely in front of Bob in the liquidation line. And honestly, Carl literally couldn't care less about voting for the board of directors.
He just wants his money.
He doesn't want to run the company. He just wants his yield. Cautious Carl is the ultimate target demographic for preferred stock.
Preferred stock is such a fascinating instrument because it really suffers from a split personality. Legally, on the balance sheet, it is equity. It represents an actual ownership stake in the corporation.
But functionally,
economically, it acts much more like debt. It acts exactly like a bond. Just like a bond pays fixed interest, preferred stock pays a fixed dividend, usually stated as a strict percentage of its par value.
so like 5% of a $100 par value.
Exactly. It is entirely designed to provide steady income.
And because it provides fixed income, we need to explicitly call out an exam trap right here. Because Carl's preferred stock pays a fixed, unchanging dividend, the actual market price of his shares behaves very strangely compared to Buffett Bob's common stock.
Yes, the market price of preferred stock is incredibly sensitive to macroeconomic interest rates. You really have to visualize a teeter-totter here.
A teeter-totter, okay.
Let's say Carl buys his preferred stock and it pays a fixed 5% dividend. A year later, the Federal Reserve decides to dramatically raise interest rates across the entire economy.
Oh, no.
Now, brand new bonds and brand new preferred stocks are being issued by companies paying a much higher, more attractive 8% yield. What happens to Carl?
Nobody wants his 5%.
Nobody wants his old stock paying 5% when they can easily get an 8% yield elsewhere. So, to entice anyone to buy his shares, Carl has to deeply discount the price of his stock. The relationship is strictly inverse.
Inverse relationship.
Interest rates go up, preferred stock prices go down, interest rates go down, preferred stock prices go up. Because preferred stock acts like a bond, it suffers from the exact same interest rate risk as a bond.
And we also need to reiterate Carl's ultimate trade-off here. Because Carl gets this preferential VIP treatment for his steady dividends, and because he gets to cut in front of Bob in the bankruptcy line, the company strips him of his voice.
Yep.
He generally gets absolutely NO voting rights.
Yep.
While Buffett Bob is passionately voting for the board of directors and arguing about the company's future, Cautious Carl is sitting quietly in the lobby, cashing his checks. He intentionally traded his voting power for financial security.
That is the core trade-off. But it's important to realize that preferred stock isn't just a monolith. When Carl goes to his broker to buy some, he is presented with a menu. Corporations engineer different flavors of preferred stock to attract different types of investors based on their specific risk tolerance.
A menu of flavors. Let's break down that menu. Push on these different flavors for a second and explain the mechanics of each one, keeping Cautious Carl in mind.
Let's start with the baseline. The first flavor is straight preferred stock. This is the absolute vanilla option. It pays a fixed dividend, let's say 5%, but it has a major structural weakness.
Which is?
If the company hits a rough patch, maybe a recession hits, and the board of directors decides they need to conserve cash and skip the dividend payment for a year, Carl is just out of luck. That missed payment is gone forever into the ether.
Carl hates that. He is cautious, Carl. He doesn't want his income stream vanishing just because the broader economy had a bad quarter. He wants guarantees. What else is on the menu to protect him?
If Carl wants maximum structural protection, he needs to buy cumulative preferred stock. And pay close attention because this is the most heavily tested flavor on the entire SIE exam.
Cumulative, got it.
With cumulative preferred, if the company is struggling and the board misses a dividend payment, that money does not disappear. The company is legally forced to put that missed payment into a special accounting bucket called an arrearage.
An arrearage bucket.
It accumulates over time like an unpaid tab at a bar. And the absolute golden rule here is that all arrearages, every single penny sitting in that bucket, must be paid out to Carl in full before the company is legally allowed to pay even 1 cent of dividends to Buffett Bob and the common stockholders.
Okay, I know exactly how they're going to test this on the exam. They're going to give you a word problem to test the math.
Always.
So I want you, the listener, to put yourself in Cautious Carl's shoes again. You own cumulative preferred stock. The company has been struggling for a few years, and they currently have $6 in accumulated arrearages from past missed payments.
$6 in the bucket.
But this year, they finally turned a massive profit. They owe you a current dividend of $2 for this year. The board also really wants to pay a huge dividend to Buffett Bob and the common stockholders to celebrate the turnaround.
They want to reward Bob.
Before Bob can get a single dime, what is the exact dollar amount the company is legally required to hand to you? Think about it for a second.
Do the math.
Think about the buckets. It's $8.
Yeah.
It is simple addition, but the exam will absolutely try to confuse you by providing answer choices that say they only need to pay the past arrearages, so $6, or they only need to pay the current dividend, $2.
Right, they will try to split it.
Nope. 6 plus 2 is 8. Every last cent of historical arrears, plus the current year's obligation, must be completely cleared before the common stock is allowed to eat.
That is a perfect execution of the math. Now, just for the sake of contrast, let's look at the exact opposite. Non-cumulative preferred.
Non-cumulative.
This is exactly what it sounds like. If the board misses a dividend, it is permanently erased. There is no catch-up. There is no arrearage bucket.
But wait, if non-cumulative offers zero protection, why would anyone ever buy it instead of cumulative?
Yield. Because non-cumulative is structurally riskier for Carl, the company usually has to bribe him to buy it by offering a slightly higher starting dividend rate.
Ah, another bribe.
Yep. Maybe the cumulative pays 5%, but the non-cumulative pays 6%. It's a pure risk-reward calculation.
Okay, what if Carl wants a little bit of the action? Like he loves the safety of his fixed dividend, but he's watching the company generate record-breaking multi-billion-dollar profits, and he wants a small piece of that explosive upside.
Then he would look for participating preferred stock. This is a very unique structure. It gives Carl his safe, fixed baseline rate, say 5% plus an additional bonus, a participation kicker, if the company's common stock earnings exceed a certain predefined threshold.
Oh, that's cool.
Yeah, if the company has an absolute blowout year, Carl gets his 5% plus an extra 1 or 2% as a special bonus. It gives him a tiny capped taste of Buffett Bob's unlimited upside while keeping his safety net firmly in place.
And then there is the trickiest flavor on the menu, the one that feels like a hidden trap just waiting to spring on an unsuspecting investor. Callable preferred stock.
Yes. When you see the word callable on the exam, you need to immediately stop and ask yourself, who does this feature actually benefit? The answer is always the issuer.
The company.
The company. Callable Preferred gives the corporation the contractual right to force Carl to sell his shares back to them at a predetermined price after a certain date.
But why would the company want to forcefully buy back their own stock from Carl? What is the mechanical incentive there?
Go back to our interest rate teeter-totter. Let's say the company issued this preferred stock 10 years ago when global interest rates were sky high, so they had to offer Carl a massive 8% dividend to get him to buy it.
Okay.
But today, the economy has changed and general interest rates have plummeted to 4%. The company's CFO is going to look at the balance sheet and say, why on earth are we still paying Carl 8%?
Right, it's too expensive.
Let's call his stock. We will force him to sell it back to us. We will retire those expensive shares, and then we will issue brand new preferred stock to the public at the new, cheaper 4% rate.
Wow, so the company saves millions.
The company saves millions in cash flow. But Carl is devastated. He loses his incredible high-yielding income stream, and he is forced to take his cash and try to reinvest it in a weak market that is only paying 4%.
That is brutal.
Callable Preferred entirely protects the company, and it actively hurts the investor. And again, just like non-cumulative, the only way a company can convince an investor to buy callable stock is to bribe them with a higher initial dividend rate to compensate for that call risk.
That makes perfect sense. The company pays a premium for the flexibility to screw Carl over later if rates drop. Okay, so Carl is sitting there. Maybe he avoided the callable trap, and he's holding a safe, straight preferred stock. He is comfortably collecting his 5% dividend. But something wild is happening. The company just announced a revolutionary breakthrough. The common stock price on the open market is absolutely skyrocketing. It's up 200%.
Huge news.
Buffett Bob is suddenly becoming a multi-millionaire, and cautious Carl is sitting in the lobby with his safe little 5%, getting massive FOMO.
The fear of missing out.
The fear of missing out is eating him alive. He wants to have his cake and eat it too. How can he participate in that explosive, life-changing growth without giving up his safety net initially?
This brings us to one of the most brilliant financial engineering inventions in the market: convertible securities. This is the ultimate bridge between the safety of fixed income debt and the explosive, unlimited upside of equity.
A bridge, I like that.
You can have convertible preferred stock, or you can have convertible corporate bonds. These are hybrid securities that start out acting one way, but they embed a magic option that allows the investor to literally transform them into shares of common stock at a later date.
It's like a financial transformer. It has a split personality.
Exactly.
When the company's just doing okay and the stock price is flat, the convertible security acts exactly like a bond or standard preferred stock.
Yeah.
It just sits there, paying Carl his steady, fixed income. He is safe. He is protected from any downside in the common stock.
Right.
But if the company invents the next iPhone and the common stock goes to the moon, Carl can call his broker, press a button, surrender his safe preferred stock, and magically receive shares of common stock in return. Now he's riding the rocket ship right next to Bob.
That's the dream.
But let's dig into the why here. Why would bankrupt Brenda or any corporate CEO agree to issue these? It sounds like the greatest deal in the world for Carl. What is the structural benefit for the company?
The benefit for the company is immediate cash flow relief. That is the core trade-off. Because the company is giving Carl this incredibly valuable embedded option to convert his shares later and potentially strike it rich, the company can demand that Carl accept a significantly lower yield on the front end.
Lower yield.
If normal, non-convertible preferred stock is paying 6%, the company might issue a convertible version paying only 3 or 4%. Carl willingly accepts less cash today for the dream of converting it into a fortune tomorrow.
So it's cheaper money for the company.
Exactly. It saves the company massive amounts of cash flow in the short term, and it attracts a specific demographic of investors who want a safety net but still want to dream big.
All right, let's anchor this abstract concept with some hard numbers, because the SIE exam is absolutely going to make you calculate the math behind this transformation.
Time for math.
Imagine a massive math alarm going off in your head right now. You need to know the formula for the conversion ratio completely cold. The formula is par value divided by the conversion price equals the conversion ratio.
Let's walk through those variables slowly. The par value is the structural face value of the security, usually $1,000 for a corporate bond or $100 for a preferred stock. The exam question will explicitly give you that number.
Okay, par value is given.
The conversion price is the locked-in price per share that Carl is contractually allowed to buy the common stock at when he decides to convert. The exam will give you that number too. Your only job is to divide them to figure out exactly how many shares of common stock Carl will receive if he pulls the trigger.
Time for another direct question to the listener. Stop what you are doing and run this math in your head.
Run the numbers.
You are holding a convertible corporate bond. The par value is $1,000. The conversion price written on the bond certificate is $50. How many shares of common stock do you get if you decide to convert today?
Par divided by conversion price.
Got it. 1,000 divided by 50. You get 20 shares. Your conversion ratio is 20. It is simple division, but here's where people mess up. Do not use the current fluctuating market price of the bond for this formula.
Right.
Always use the fixed par value.
Exactly. Always use par. And knowing that you get 20 shares unlocks the next, more advanced concept the exam tests.
Parity.
Parity. Parity is the theoretical break-even point. It is the exact moment where the mathematical value of your bond is identical to the market value of the common stock you could turn it into. Let's explore the mechanics of this. You did the math. You know your bond turns into 20 shares. You look at your trading terminal and see that the company's common stock is currently trading at $60 a share on the open market.
Wow, stock went up.
Since you hold a piece of paper that can instantly, magically be turned into 20 shares, and each of those shares can be sold for $60, what is your convertible bond intrinsically worth right now? 20 times 60. Your bond is intrinsically worth at least $1,200.
And this creates a fascinating market dynamic called arbitrage.
Yes, arbitrage.
If the stock hits $60, making your bond mathematically worth $1,200, but the bond is somehow only trading at $1,100 on the bond market. High-frequency algorithmic traders are going to instantly buy the bond for $1,100, immediately convert it into 20 shares, and instantly sell those shares on the stock market for $1,200.
Woo.
They make a risk-free $100 profit in a millisecond. And because those traders are constantly buying the bond to exploit that gap, they drive the price of the bond up until it perfectly matches the stock price. The bond price is literally chained to the stock price once it rises above parity.
That is exactly how the market mechanics function. The convertible bond price will track the surging stock price tick for tick. But I want to highlight a critical trap regarding the mechanics of the actual conversion process. The exam is going to try to trick you about who holds the power.
Who pulls the trigger?
Right. They might give you a highly plausible scenario that says the common stock price hit $80, so the corporate issuer forced the bondholders to convert to common stock.
And I guarantee people will fall for that because it sounds like something a company would do.
It sounds totally plausible, but it is completely false. You must remember this rule. Conversion is always at the investor's option. The corporate issuer cannot force you to convert. The holder of the security holds all the power.
The investor decides.
They alone decide if and when to pull the trigger and transform the asset. The exam loves to test who holds the authority in these transactions. Let's contrast it. With callable preferred stock, the corporate issuer holds the power. With convertible stock, the investor holds the power.
That is a brilliant side-by-side contrast. Okay, so we've talked extensively about what happens when Carl wants to turn his existing preferred shares into common shares. But let's pivot.
Okay.
What happens when the company itself just wants to create brand new common shares out of thin air? Let's say the company's growing rapidly. They want to build a new billion-dollar factory in Mexico. So the CEO announces, we're going to issue 1 million brand new shares of common stock to the public to raise the cash we need.
Very common.
But wait, stop and think about the math. If they just print 1 million new shares, doesn't Buffett Bob's slice of the pie get mathematically smaller?
Yes, it absolutely does. If we connect this back to the core concept of ownership, this is a massive existential problem for existing shareholders. The mechanical term for this is dilution.
Dilution. Let me introduce you to our fourth character to really illustrate this pain. Diluted Dan.
Oh, poor diluted Dan.
Dan is a massive institutional investor. He owns 10% of the entire company. He loves his 10%. It gives him massive voting power. But if the company suddenly decides to double the total number of shares in existence to raise money, and Dan doesn't buy any of the new ones, his 10% ownership magically shrinks to 5%.
It gets cut in half.
His voting power is halved. His claim on the residual buffet is halved. They just let 100 new people into the buffet room without adding a single extra prime rib to the table. Dan is furious. He is standing up at the shareholder meeting screaming, "You cannot do this to me." How does the financial regulatory system protect diluted Dan from having his ownership stolen?
The system protects him with a mechanism called preemptive rights, which the exam usually just refers to as rights or subscription rights. By corporate law or by the rules in the corporate charter, before the company is legally allowed to offer those brand new shares to the general public, they must first offer them to their existing current shareholders.
Oh, like a VIP line.
They have to give Dan the preemptive opportunity to buy enough of the new shares to maintain his exact proportionate ownership. If he owned 10% of the company before the new offering, the company gives him the right to buy exactly 10% of the new batch before anyone else even sees them.
Okay, so rights are basically a VIP pre-sale ticket for a concert. You get first dibs. But wait, why would Dan want to spend millions more of his own cash just to keep the exact same percentage he already had yesterday? What structurally makes these rights attractive enough for him to actually exercise them?
There are two critical structural traits that make them attractive. And these are the exact key traits you must memorize for the exam. First, rights are extremely short-term. We are talking
Window.
It is a very tight window because the company needs to raise this cash quickly to build their factory. Second, and most importantly, the exercise price, the price Dan has to pay to buy the new shares, is intentionally set below the current secondary market price. It is an immediate built-in discount.
Let's use numbers.
Yep.
If the stock is currently trading at $50 on the open New York Stock Exchange, the company might issue rights that allow Dan to buy the brand new shares for only $45.
Exactly.
It is an instant $5 bargain designed to compensate him for the massive hassle of the new share issuance.
Exactly. So Dan has options. He can exercise the rights, hand over the $45 per share, get his discounted stock, and comfortably keep his 10% ownership intact. But what if he doesn't have the cash?
Right.
What if his fund is fully deployed and his bank account is empty? Does he just lose out completely?
No, because these rights have intrinsic mathematical value. They're basically physical coupons that say, buy a $50 stock for $45. That piece of paper is inherently worth at least $5.
Minimum.
If Dan doesn't want to use them to buy the stock himself, he can sell those rights on the open secondary market to some other investor who does want the discount. The only thing Dan should never do is just let them sit in his account for 45 days and expire worthless. If he lets them expire, he suffers the dilution and he throws away the free cash value of the coupon.
Perfectly stated. So rights are short-term, discounted VIP tickets given to existing owners to protect against dilution. But there is another concept, another W word, that sounds very similar, functions somewhat similarly, and the exam absolutely loves to smash them together in multiple choice questions to confuse you. Warrants.
Warrants?
If rights are designed to protect existing owners like Dan, what on earth are warrants used for?
Warrants are completely different in their corporate purpose. Think of warrants as a sweetener. They are a financial bribe.
Another bribe?
They are a bonus attached to a completely different, usually less attractive security to make it spicy enough for buyers to care.
Let's go back to bankrupt Brenda before she actually went bankrupt.
Oh, when she was just trying to survive.
Yeah. Let's say she is desperate for cash and is trying to sell some incredibly boring, high-risk, low-interest corporate bonds. Nobody on Wall Street wants to buy them. They are paying a terrible grade.
How does Brenda make those boring bonds attractive enough to sell?
She attaches a warrant to them. It's like putting a plastic toy inside a box of stale cereal so the kids will beg their parents to buy it.
That is a great analogy, but what does that warrant actually allow the investor to do? A warrant is a long-term option to buy the company's common stock at a fixed stated price in the future.
And when I say long-term, I mean years. 2, 5, sometimes even 10 years. Or occasionally, they are issued perpetually with no expiration. But here is the massive catch, the structural difference. Unlike rights, the exercise price of a warrant is intentionally set above the current market price at the moment it is issued.
Hold on, let's unpack the mechanics of that because it sounds counterintuitive. The stock is currently trading at $50 today.
Right.
Brenda attaches a warrant to her bond that says, congratulations, anytime in the next 5 years, you have the right to buy our stock for $65.
Right.
That sounds like a terrible deal right now. Why would any rational investor care about a coupon that forces them to overpay for a stock?
Because of the massive time horizon. Right now, today, yes, the stock is at 50 and the warrant requires you to pay 65. The warrant is currently out of the money and essentially useless. But the investor has 5 entire years. If Brenda turns the company around, invents something incredible, and the stock price moons to $150 a share 3 years from now, suddenly that little piece of paper that lets you buy it for a locked-in price of 65 is incredibly, massively valuable.
Oh, I see.
It is a long-term, leveraged bet on the company's ultimate success. Brenda gets people to buy her boring bonds today by handing them a lottery ticket that might pay off tomorrow.
All right, this is an absolute exam goldmine. I want to put these two concepts in a cage match, rights versus warrants. I want rapid contrast because this side-by-side comparison is exactly how they will test your comprehension.
Let's do it.
Let's go through the trade side-by-side. First round, duration.
Rights are distinctly short-term. They are measured in days, usually 30 to 45. Warrants are distinctly long-term. They are measured in years, usually 2 to 5 plus.
Second round, exercise price compared to the current market.
Rights are issued below the current market price. They are an immediate built-in discount. Warrants are issued above the current market price. They require the underlying stock to grow into them over time.
Third round, core corporate purpose.
Rights are issued specifically to prevent dilution for existing shareholders. Warrants are issued as a sweetener, a structural bribe, to make a completely different debt or preferred stock offering more attractive to brand new investors.
Perfect contrast. And let's hit one more critical mechanical distinction regarding both of these tools, because people confuse them with standard options.
Right. The exam will try to confuse you by mixing up warrants with standard stock options, like a call option you might buy on your Robinhood app. Warrants are issued directly by the corporation itself.
Not the exchange.
Not the OCC, the Options Clearing Corporation, which handles standard exchange-traded options. That is a huge regulatory distinction. And furthermore, think about the mechanics of exercising them. If you exercise a regular OCC call option, you are just forcing another random investor to sell you their existing shares.
You're just swapping shares.
Exactly. But if you exercise a warrant, right, or if you exercise a warrant, you are dealing directly with the company. The company has to literally print brand new shares out of thin air to hand to you. Because both rights and warrants result in the creation of new stock, it means both of them ultimately cause dilution to the total share pool once they are exercised.
Wow. Okay, everyone take a deep breath. We are covering massive ground here.
So much ground.
We've talked about common stock, the brutal reality of bankruptcy priority, the hybrid nature of preferred stock, the arbitrage of convertibles, and the cage match of rights versus warrants.
Right.
But up until this very moment, all of this assumes that these shares are just trading freely, out in the open on the secondary market. You'd log into your brokerage app, you click buy, you click sell, the trade settles in a day, and you move on. Easy.
Super easy.
But what if you aren't just a normal, everyday retail investor? What if you are the visionary founder of the company? What if you bought your shares in a highly secretive backroom venture capital deal years before the company even went public?
Oh, then the rules change.
Big time. If you are an insider, you cannot just dump millions of shares onto the public market whenever you feel like buying a new house.
No, you absolutely cannot. The Securities and Exchange Commission, the SEC, is deeply historically terrified of this exact scenario. If you look back to the market crash of 1929, a major contributing factor was corporate insiders secretly dumping their shares before the public realized the companies were failing.
It crashed the market.
Exactly. The SEC wants to protect the everyday public investor from being blindsided by insiders flooding the market and artificially crashing the stock price. And this historical fear brings us to one of the most technical, math-heavy, but absolutely vital rules on the entire SIE exam, SEC Rule 144.
SEC Rule 144. I like to call this the velvet rope. This rule dictates exactly who is allowed inside the VIP club and, more importantly, exactly how they are allowed to leave. To explain the mechanics of this, we need to introduce our final character of the day, Insider Ivan.
Ivan the Insider.
Ivan is the CEO of a massive publicly traded tech company. He sits on the board of directors. He personally owns 15% of all the outstanding shares in existence. Ivan is an incredibly big deal. Now, Ivan has decided he wants to buy a massive multi-million-dollar yacht, and to pay for it, he needs to liquidate a huge chunk of his company's stock. The exam is going to ask, can Ivan just open his E-Trade account and hit sell all?
Not a chance. Rule 144 stands directly in his way. Now, to truly master Rule 144 for the exam, you have to realize that it is actually governing two completely different regulatory concepts that often get tangled together in people's minds.
Let's untangle them.
It governs restricted stock and it governs control stock. The absolute easiest way to keep them separate in your brain is this framework. Restricted stock is entirely about how you acquired the shares. Control stock is entirely about WHO, you are as a person.
I love that framing. It simplifies everything. Restricted is HOW. Control is WHO. Let's break down the HOW first. Explain the mechanics of restricted stock.
Restricted stock means you acquired these shares in an unregistered private transaction. You didn't buy them clicking a button on the New York Stock Exchange. Maybe you bought them directly from the company in a private placement, like a Regulation D offering, years before the company ever had an IPO.
Okay, so they were never officially registered.
Because these specific shares were never officially registered with the SEC for public sale, they haven't gone through the rigorous disclosure process. So the SEC says, hold on. You cannot just buy unregistered shares in a backroom deal and then turn around the next day and dump them onto the public market. That makes you an unregulated underwriter.
Right.
To prevent that, the SEC mandates that you must satisfy a strict holding period before you are legally allowed to sell them to the public. You have to prove you bought them as a long-term investment, not just to flip them.
And what is the exact timeline for that holding period? Because I know for a fact the exam tests the exact number of months.
The timeline depends entirely on the transparency of the company. If it is a standard reporting company, meaning they're already public, they're actively trading, and they file all their regular audited financial reports like 10Ks and 10Qs with the SEC, the holding period for restricted stock is 6 months.
6 months.
You must hold it for 6 continuous months. If, however, it is a non-reporting company, meaning they do not file standard SEC financials and the public has less information about them, the SEC requires more time to prove your intent. The holding period is doubled. It is 12 months.
So 6 months for reporting, 12 months for non-reporting.
That is the fundamental rule for restricted stock. It is entirely based on how you acquired it.
Okay, so that perfectly covers the HOW.
Right.
Restricted stock has strict holding periods. Let's pivot to the WHO. Let's talk about control stock. This is where our CEO, Insider Ivan, comes in.
Yes, control stock is defined exclusively by who currently owns it. If the stock is owned by an affiliate, it is automatically classified as control stock.
Who is an affiliate?
The SEC has a very strict definition of an affiliate. You are an affiliate if you are an officer, like the CEO, CFO, or president, or a director sitting on the board, or any single shareholder who owns 10% or more of the outstanding voting shares.
So the bigwigs.
Think about why the SEC chose those 3 categories. Those are the people in the room where it happens. They see the quarterly earnings before anyone else. They know if a major product is failing.
Ivan is all 3 of those things.
He is the CEO, he's on the board, and he owns 15%. He is the ultimate affiliate. Because Ivan has immense control and inside knowledge, the SEC puts a very tight leash on his ability to sell.
And that leash is mechanically enforced by a volume limit. The SEC says, Ivan, we aren't going to stop you from buying your yacht, but you cannot flood the market and artificially crash the stock price by selling all your millions of shares on a random Tuesday.
Mm-hmm.
So they restrict the sheer volume of shares he is legally allowed to sell in any given 90-day window.
Exactly. And the mathematical formula for this volume limit is highly, highly testable. When Ivan goes to his broker to sell, he is allowed to sell the greater of 2 calculated numbers.
The greater of.
Either 1% of the total outstanding shares of the entire company, or R, the average weekly trading volume of the stock over the preceding 4 weeks. Whichever of those 2 mathematical numbers is larger, that becomes his absolute maximum speed limit for selling over the next 3 months.
Let's run a quick simulation to make that real. Let's say Ivan's company has 10 million shares outstanding in total. 1% of 10 million is 100,000 shares. Now let's look at the trading volume. Over the last 4 weeks, the stock has been lightly traded, averaging only 80,000 shares a week. Ivan gets to pick the greater of the 2.
Which is?
Since 100,000 is greater than 80,000, Ivan is legally capped at selling 100,000 shares over the next 90 days. But here's the massive trap that the exam sets for you. It's a scenario that catches almost everyone.
Oh, I know the trap. Let's hear it.
We established Ivan as an affiliate. He has volume limits on his control stock. But what if Ivan, the billionaire CEO, decides to just log onto his personal E-Trade account and buy 1,000 shares of his own company on the regular open public market, just like you or I would?
Okay.
He didn't get them in a secret backroom deal. He paid market price on the New York Stock Exchange. These are not restricted shares. Does Ivan still have volume limits when he goes to sell those specific open market shares later?
Yes. This is exactly where people fail. Affiliates always have volume limits, regardless of how they got the shares. Because of WHO, Ivan is because he is an affiliate. Every single share he touches, breathes on, or buys magically transforms into control stock and becomes instantly subject to the volume limits.
So the open market doesn't save him.
Even if he buys it on the open market, he cannot escape his status as an insider. His identity supersedes the origin of the shares.
Let me flip that exact scenario around to really lock in the difference between WHO and HIW. What if my grandmother, who lives in Ohio, has zero connection to the company and has absolutely no insider knowledge? What if she somehow buys restricted stock in a private placement?
Okay, grandmother in Ohio.
She is a non-affiliate holding restricted stock. She waits her mandatory 6-month holding period. Can she just sell all of her shares at once? Or is she subject to the volume limits too?
She can sell every single share at once. Non-affiliates do not have volume limits. Once she waits out the 6-month holding period to satisfy the HIW rule, she is completely free.
Because she's not an insider.
Because she is not an insider, the SEC doesn't care about her volume. Only affiliates, the insiders, are trapped by volume limits forever.
That is such a crucial distinction to internalize. Affiliates always have volume limits. Non-affiliates only have holding periods if the stock is restricted. And once that time passes, they are totally unrestricted. Okay, one more mechanical detail on Rule 144 before we let Insider Ivan go buy his yacht. If Ivan actually wants to execute this sale, he can't do it in secret.
Right.
He has to publicly tell the SEC he is doing it so the market can react. He has to file a Form 144. What is the mathematical threshold that triggers that exact paperwork?
He must file Form 144 at the exact time he places the sell order if he is planning to sell more than 5,000 shares, or R, if the total dollar amount of the sale exceeds $50,000 within a 3-month period. Notice the OR.
5,000 shares or $50,000.
He trips either one of those tripwires, he has to file the form, and that form becomes public record, which is why you often see news articles saying CEO files to sell $10 million in stock. The exam loves to test those exact tripwire numbers. 5,000 shares, $50,000.
Okay, take a breath. We have conquered the math of Rule 144. We have conquered the absolute priority waterfall of bankruptcy. We have looked deeply into all these US-based securities, but let's expand our horizon.
Let's go global.
What if Ivan's tech company is doing so incredibly well that it's catching the eye of international investors? Or let's flip it to your perspective, the listener. What if you are sitting at home looking at your portfolio and you decide you want to diversify? You want to buy a piece of a massive European car company or a Japanese electronics giant.
Very common strategy.
But you don't want to fly to Tokyo to open a foreign brokerage account. You don't want to wire money across the ocean and pay massive bank fees. You don't want to figure out how to buy stocks using euros or yen. How do you, an everyday American investor, buy foreign equity while sitting on your couch?
This is a fantastic transition because it introduces our final major equity product of the deep dive, American Depositary Receipts, usually just called ADRs. This is an incredibly elegant structural solution to a very complex logistical problem in international finance.
I like to think of an ADR like a financial translation service. It takes a complex foreign-denominated asset and translates it into something a U.S. investor can easily digest. But how does the actual plumbing work behind the scenes to make this translation possible?
It starts with a major U.S. depository bank. Think of an institution like J.P. Morgan or Citibank. That U.S. bank reaches out to the foreign market and literally buys millions of shares of the foreign company.
Like the European car manufacturer.
Exactly. The U.S. bank buys the shares on the European exchange, priced in euros, and literally locks those physical shares away in a custodian vault overseas. Then the U.S. bank turns around and issues receipts against those shares held in the vault. These receipts are the ADRs. They are a domestic claim on a foreign asset.
And the absolute beauty of this system is that those ADRs trade right here on U.S. exchanges. They trade on the New York Stock Exchange or the NASDAQ. You can buy them in your normal Robinhood or Fidelity account right next to Apple and Amazon.
And in U.S. dollars.
Exactly. And most importantly, they trade in U.S. dollars. You never have to convert your money. Furthermore, when that European car company pays a dividend out in euros, the U.S. bank receives the euros, mechanically converts them into U.S. dollars at the current daily exchange rate, and deposits those U.S. dollars directly into your brokerage account. It feels completely seamless.
It feels seamless from an operational standpoint, but that seamlessness introduces a massive psychological blind spot for investors, and it creates a massive testing area for the SIE exam.
Oh, here's the trap.
Because everything is happening in familiar U.S. dollars, investors mistakenly believe they are somehow insulated from international market risks.
Okay, this is a perfect moment for a direct question to the listener. Think critically about the plumbing we just described.
Huh.
Since you are buying an ADR on a familiar U.S. exchange, and you are paying for it in U.S. dollars, and you are receiving your dividends in U.S. dollars, are you safe from foreign currency exchange risk? Think about it.
Think about what's in the vault.
Let me guess. The exam is going to try and trick me into thinking I'm perfectly safe because I only ever see dollars. But the answer is NOPE. You are absolutely not safe.
You are not safe at all, and let's explore exactly why, because understanding the mechanism here is key. Yes, you hold a receipt that is priced in dollars, but that receipt represents a share of stock sitting in a vault that is fundamentally priced in euros. The value of your ADR is mathematically inextricably tied to the fluctuating value of those euros.
So if the euro drops,
If the euro suddenly crashes on the global currency markets and loses 20% of its value compared to the US dollar, the underlying asset your ADR is based on just became 20% less valuable in dollar terms. The US bank is going to have to immediately lower the trading price of your ADR to match that currency devaluation, even if the car company itself is doing great.
and this currency risk hits your dividend checks too. Let's say the car company declares a dividend of €1 per share. When they declared it last year, the exchange rate was strong. €1 equaled $1.50. So you got a check for $1.50. You're happy.
Right.
But this year, the euro crashes. Now, €1 only equals 80 cents. The company still pays the exact same €1 dividend. They didn't cut the dividend at all. But when the bank converts it and hands it to you, your payout shrank to 80 cents. You lost almost half your income strictly because of currency fluctuations. You must remember, ADRs still carry currency risk.
Exactly. The currency risk passes right through the translation service. Another major risk that trips people up on the exam is taxation. If you own a piece of a European company and they pay out a profit, the European government is going to want a piece of that action.
And want their cut.
They don't care that you live in Ohio. They might apply a foreign tax withholding and take a cut of the dividend before the money ever leaves Europe.
Wait, hold on. If the foreign government takes a 15% cut, and then I get the money in the U.S., the IRS is going to want their cut when I file my taxes in April. Am I getting double tax on the exact same dividend? That sounds like a terrible investment.
That is a very logical fear, and it's exactly what the test writers want you to worry about. But the answer is generally no. The exam wants you to know that foreign tax withholding does not equate to double taxation.
Okay, good.
The U.S. IRS recognizes that you already paid taxes to the foreign government. So, to prevent double taxation, the IRS typically allows you to claim a foreign tax credit on your U.S. tax return. It basically offsets your U.S. tax liability dollar for dollar based on the exact amount that was withheld overseas. So you aren't paying twice, but it does make your accounting paperwork a bit more complicated.
So we have currency risk passing through, we have foreign tax withholding rules, and obviously we have political risk. If the foreign government decides to nationalize the car company or radically change their corporate laws, your ADR is going to suffer.
Exactly.
Now, just like preferred stock comes in different structural flavors, ADRs come in different structural tiers based on how involved the foreign company is. Let's look at the difference between sponsored and unsponsored ADRs.
This is a crucial distinction about corporate cooperation. Let's start with unsponsored. An unsponsored ADR means the U.S. depository bank just decided to do this entirely on its own initiative. They saw demand for the stock, so they went and bought the shares, put them in a vault, and issued the receipts.
So the foreign company has nothing to do with it.
The foreign company might not even know it is happening. They certainly aren't cooperating, they aren't paying any fees to the bank, and they aren't translating their complex financial documents into English for the SEC. Because of this complete lack of transparency and lack of issuer involvement, unsponsored ADRs are considered significantly riskier.
And because they are riskier and they lack that strict SEC oversight and English documentation, where are they actually allowed to trade?
Because they don't meet the strict listing requirements, they are restricted to trading exclusively on the over-the-counter market, the OTC market. You will never, ever see an unsponsored ADR trading on a major regulated exchange like the NYSE or the NASDAQ. The rules are just too strict for a company that isn't cooperating.
Okay, what about the alternative? Sponsored ADRs.
A sponsored ADR means the foreign company actively wants access to U.S. investors. They want that American capital. So they actively cooperate with the U.S. bank. They sign a formal embodiment. They agree to translate their financial documents into English and adhere to certain SEC reporting standards.
Now they're playing ball.
Because they are playing ball with the U.S. regulators, they are granted access to better, more liquid markets.
And within sponsored ADRs, there's a specific hierarchy. There are 3 distinct levels: level 1, level 2, and level 3. Let's run through the mechanical differences quickly because the exam specifically targets what each level is allowed to do.
Level 1 is the lowest tier of sponsored. The foreign company cooperates a little bit, but they only want to meet the absolute minimal SEC requirements to save on auditing fees. Because of that minimal compliance, even though they're officially sponsored, level 1 ADRs are still relegated to trading only on the OTC market.
Level 2 steps up the compliance.
Yes, level 2 means the foreign company decides to fully register with the SEC. They do the heavy lifting of full compliance, which costs them significant time and money. As a reward for that transparency, level 2 ADRs are legally allowed to list and trade on the major U.S. exchanges like the NYSE and NASDAQ. This gives the foreign company massive visibility and trading liquidity.
And finally, level 3, the absolute top tier. Now, I know the exam is going to hone in on this. What makes level 3 structurally different from level 1 and level 2?
Level 3 is the only level that allows the foreign company to actually raise brand new capital directly from U.S. investors. Think about it. Levels 1 and 2 are just the U.S. bank trading existing shares that they found on the secondary market. The foreign company doesn't make any new money from that.
It's just shares changing hands.
Right. But with the level 3 ADR, the foreign company creates a full prospectus, registers a brand new public offering with the SEC, and sells brand new shares directly into the U.S. market to raise fresh cash to build new factories or fund operations. Only level 3 can be used to raise new capital. That is a highly, highly testable fact.
Boom!
Yeah.
Only level 3 raises new capital. Okay, my friends, we have been on an absolute exhaustive journey today.
What a deep dive.
We started with Buffett Bob standing at the back of the residual buffet line. We watched bankrupt Brenda's factory get liquidated piece by piece. We explored the hybrid teeter-totter of cautious Carl's preferred stock. We saved diluted Dan with preemptive rights. We restricted insider Ivan's yacht purchase. And we ended up translating foreign equity into U.S. dollars with ADRs.
We've covered it all.
If you have stayed locked in with us, you have just organically absorbed a massive percentage of the equity knowledge required to pass the SIE. But to make sure this sticks in your brain before you walk into the testing center, we're going to do a rapid-fire recap. I'm going to throw out the concept, and we're going to hit the core testable takeaway at lightning speed. Ready? Let's go.
Ready.
Common stock ownership.
Residual owner. You eat last, but you have the potential for unlimited upside.
Limited liability.
The firewall. You can lose 100% of your investment, but creditors absolutely cannot touch your personal assets. You lose nothing more than what you put in.
The 2 types of voting rights.
Statutory voting benefits the majority shareholder by keeping votes in silos. Cumulative voting helps the minority shareholder by letting them pool all their votes onto a single seat.
Liquidation priority in bankruptcy. The absolute rule.
Debt always, always beats equity. The exact order is secured creditors first, then unsecured creditors, then subordinated debt, then preferred stock, and finally common stock dead last.
Preferred stock characteristics.
It acts like a hybrid bond. It pays a fixed dividend, it generally has absolutely no voting rights, and its price is highly sensitive to interest rates. If general rates go up, the price of preferred stock goes down.
Cumulative preferred stock.
The arrearage bucket. All past missed dividends must be paid in full, plus the current dividend, before common stockholders are allowed to get a single penny.
The convertible ratio math formula.
Par value divided by the conversion price. Always use par, never the market price. And remember, the act of conversion is always at the investor's option, never the company's.
Rights versus warrants, the cage match.
Rights are short-term, given to existing shareholders to prevent dilution, and the exercise price is set below the current market. Warrants are long-term, attached as sweeteners to boring bonds, and the exercise price is set above the current market. But remember, exercising either of them results in new shares, which causes dilution.
SEC Rule 144. Insiders and the velvet rope.
Control stock. Affiliates, the insiders, always have volume limits when they sell, regardless of whether they bought the stock in a backroom or on the open market. Restricted stock. Requires a 6 or 12-month hold depending on the company's SEC reporting status.
And finally, ADRs.
American depository receipts let you trade foreign stocks on U.S. exchanges in U.S. dollars, but they still carry foreign currency risk. If the foreign currency drops, your ADR value and your dividend drop with it.
Absolutely brilliant. If you can fundamentally understand those bullet points and the why behind them, You are going to absolutely crush this section of the exam. But before we let you go, we always like to leave you with something to chew on. Something that takes the rigid rules we just learned and pushes them into the messy reality of the real world.
Right. We've talked extensively today about the absolute priority rule, how secured creditors fiercely beat out unsecured creditors, and how debt always beats equity. We mapped out exactly how bankrupt Brenda's company gets liquidated under strict United States bankruptcy law.
Yeah, U.S. law.
And we just finished talking about ADRs and the geopolitical risks of holding a U.S. receipt for a foreign asset. But I want you to think about this intersection, this collision of rules. What happens if you're holding an ADR and that foreign company goes completely catastrophically bankrupt? You are holding a receipt issued by a prestigious U.S. bank in New York, and it's trading in U.S. dollars. You feel secure. But the actual company, the actual physical assets, the factories, the patents, the cash are being liquidated under the laws of a completely different sovereign nation.
Not under U.S. bankruptcy court.
Exactly. Maybe it's a country that doesn't prioritize secured debt the same way we do in America. Maybe it's a country where the government legally claims the assets first, or the labor unions take priority before any foreign investors see a dime. Your spot in that Buffett-Bob residual line might not just be at the very back. It might be in a different time zone altogether, governed by a rule book written in a language you don't speak.
That is insane to think about.
How much protection does a U.S. receipt really offer when the underlying asset is completely subject to the mercy of foreign bankruptcy courts? It is a stark reminder that an ADR is merely a window into a foreign market. It is not a shield against it.
A window, not a shield. That is a terrifying and fascinating thought to end on. Keep that dynamic in mind as you study. Remember, you aren't just memorizing dry facts to pass a test. You are learning the actual structural plumbing of the global financial system. Keep crushing your SIE prep. You have just conquered one of the most heavily tested, mathematically intense sections of the entire exam. Be proud of that. Keep studying, keep reviewing those flashcards on CertFuel, and we will see you on the next deep dive.